Welcome back to the channel, everyone. Today I want to talk about whether the SEC is siding with Citadel or siding with us. I'm going to start by talking about why the SEC might actually be on our side and doing us many favours. But then again, I'm also going to talk about all the instances where the SEC has failed us and proved time and time again they are siding with Citadel. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, former SEC branch chief Lisa Briganca says that 90 to 95% of market orders are filled away from regulated lit exchanges that are regulated and transparent. And she says this makes absolutely no sense. Gary Gensler says the SEC will be issuing rule proposals to try and fix this. She says that Gary Gensler notes that payment for order flow is banned in the UK, Canada, and the EU is also working on a ban. Those markets did not crash when payment for order flow was banned, so it is possible to ban payment for order flow without the sky falling in. Gary Gensler also says the SEC will be looking at market plumbing, clearing, settling, and limiting buys. This is harder to do than you might think. There's obviously lots of vested interests in the current system, and many current intermediaries make lots of money and they will not want to give up those profits. So far, Gary Gensler has only said that he's going to be looking at market plumbing. He's only said that he's debating a ban of payment for order flow, and he's only said that 90 to 95% of market orders being filled away from regulated lit exchanges is a bad thing. So far, he's only said these things, but so far he's not yet made any meaningful changes. However, if Gary Gensler does end up issuing some decent rule proposals, and those proposed rules get approved, that can only be a good thing. If Gary Gensler can somehow create a rule that means a larger percentage of market orders get filled in the lit exchanges, that can only be better for the market as a whole. Something the SEC has done recently is proposed ruling 9J-1 to mitigate and prevent fraud, manipulation and deception in connection with security-based swap transactions. We know that security-based swaps are what Archegos used back in March of 2021 when they almost crashed the entire market. And we also know that security-based swaps are one of the things that hedges are currently using to kick the can and transfer their short positions to other hedge funds. A security-based swap is what Citadel could have used to swap all of their short positions over to another hedge fund like Melvin Capital, for example. This proposed ruling will basically minimise the number of actual reasons that security-based swaps can be used for, basically meaning that the hedgies won't be able to use security-based swaps to kick the can and transfer large synthetic short positions onto other hedge funds. On top of that, the SEC has also proposed a new ruling to adjust or amend Form PF to make sure that hedge funds have to advise the SEC when they enter a regulatory event such as a margin call or massive losses. I covered this in one of my videos from the other day. And therefore, so far the SEC has proposed and passed many new rules that are bringing the squeeze ever closer as the SEC is getting prepared for this market crash. Guys, if you're getting a little bit worried holding your AMC and Fidelity due to all the recent glitches and the fact that Fidelity actually supports short sellers, Moomoo are currently buying you a free share of AMC on top of their usual 5 free shares when you sign up to Moomoo using the link in the description below and make your first deposit. When you sign up to Moomoo and make your first deposit, you get 2 free shares valued up to $3,500 each. If you can deposit $100, then you also get this free share of AMC bought specifically for you. And if you can deposit the full $2,000, then you also get an extra 3 free shares valued up to $3,500 each. Moomoo is also a brilliant commission-free trading platform that doesn't make its money from payment for order flow. Moomoo and Futu make their money from margin interest and from payment fees, and therefore you don't have to worry about your trades going through sketchy dark pools or being given to Citadel. And Moomoo also has excellent technical indicators and advanced charting tools. Moomoo publishes daily short selling volume on top of a number of other key important metrics. So guys, be sure to sign up to Moomoo using the link in the description below to get up to 5 free stocks valued up to $17,500 and a free share of AMC. But saying this, there's also so many instances where the SEC have failed to do their duty and effectively protect the market from this market manipulation, which would, as a byproduct, cause the AMC squeeze. Obviously, the SEC's job isn't to cause the AMC squeeze. The SEC's job is to protect the market from market manipulation and protect investors. Obviously, by protecting AMC investors, it would effectively cause AMC to squeeze. For example, dark pool abuse for AMC is at insane levels. It's at 60 to 70% on average on a daily basis for certain securities like AMC and GameStop. This means that 60 to 70% of all trades are performed in the dark pool. The majority of retail trades, obviously 90 to 95% of trades, don't go to lit exchanges. But so far, Gary Gensler has done absolutely nothing to stop the dark pool abuse. On top of this, there's a rule that states that the SEC can basically ban or shut down payment for order flow and suspend dark pools for up to 1 year. This would obviously also ban alternative trading systems and over-the-counter trading. So this rule is SEC Rule 304A4, suspension, limitation or revocation to the exchanges. I have spoken about this rule on my channel before, but obviously I'll leave the link down in the description below so you can read this rule for yourself. But effectively, this rule allows the SEC to effectively ban, halt, limit, restrict or revoke access entirely to any alternative trading system, ATS, and or dark pools that connect to the exchange. The SEC can fully enforce this rule at any time for a period of up to 12 months if deemed beneficial to retail investors or just beneficial to protect the interest of investors. This rule also states that the procedures to actually carry out said rule are already in place. And this ruling was actually passed on October the 9th, 2018, as in over 3 years ago. He says this rule was created for the exact situation we are in right now. And by that I think he means that this rule wasn't necessarily created just to make AMC squeeze, but what this rule was created for was to stop the 60 to 70% of trades going through dark pools. Dark pools should theoretically only make up a small portion of total shares traded, and it definitely should not make up 90 to 95% of all retail orders. He says either Gary Gensler doesn't know about this rule, which I think is unlikely considering how much we've been talking about this rule over the last year, or he thinks that we don't know about it. Again, I think Gary Gensler also knows that we know about this rule, but I think he's just trying to avoid addressing the situation. Whether Gary Gensler is avoiding the situation because the SEC aren't ready for AMC to squeeze and the market to crash quite yet, or they're avoiding it because the SEC is siding with Citadel, I don't know. But hopefully in this video, I'm hoping to answer that question. He says the fact that he made dark pool abuse public means it's our duty to make this public. How could he not enforce a rule designed to stop what he just announced was going on? This is a huge deal. Now obviously in this video, copied by Lisa Brianka, Gary Gensler did announce that 90 to 95% of retail market orders are filed away from regulated lit exchanges, and therefore Gary Gensler knows about the dark pool abuse, and therefore he must know about this rule that can address it. Now on top of that, Lisa has also tweeted saying, why does Finra repeatedly say that Citadel has no relevant disciplinary history in settlements of disciplinary actions, when actually that's not true whatsoever. Citadel has a massive history of paying fines and receiving disciplinary action. She says that sometimes Finra even goes as far to say that Citadel has no disciplinary history at all. You can see here a ruling from Finra that says Citadel Securities LLC has been a member of Finra since February 2005. Citadel Securities primarily engages in market making and provides execution services in US equities, options, government securities and foreign exchange products. It says Citadel Securities is headquartered in Chicago, Illinois, and as of February 2021, Citadel Securities has 7 branch offices with approximately 400 registered representatives. And it also says the firm does not have relevant disciplinary history. And obviously we know that's absolutely rubbish, because all you need to do is Google Citadel disciplinary history or Citadel fines and you get tons and tons of results for different fines that Citadel has paid over the years. I can't find the comment, but I saw somebody that said that the reason Finra can say this is because Citadel never actually admit to any wrongdoing, they just pay the fine. Obviously Citadel know they're guilty, they don't admit to it, but they pay the fine, which shows that they are absolutely guilty of the wrongdoing. And on top of this, Hang Loose says, why won't the SEC ask each broker to report how many shares they hold of meme stocks just to make sure everything is in order? I've gone through previous videos that shows that Webull holds hundreds and hundreds of millions of shares of AMC alone. Obviously, the calculations performed by Count the Float show that Webull only hold a very small portion of AMC, and therefore there's at least 2.5 to 3 billion AMC shares in issue. Obviously, this means that Webull own hundreds of millions of AMC shares. Robinhood also likely own hundreds of millions of AMC shares, and Fidelity actually likely own billions of AMC shares. And therefore, all the SEC would have to do is to get Finra, Robinhood, Webull and other brokers like TD Ameritrade to report how many shares of AMC they're actually holding. And that would once and for all very, very quickly expose just how many synthetic shares there truly are. It'd literally take the SEC 5 minutes to ask these brokers and for the brokers to provide the SEC with the numbers. But obviously, still to this day, the SEC haven't asked this of the brokers, they just don't seem to care. As Hang Loose says, upon request, that info could quite literally be delivered in a single day. Brokers provide portfolio statements to all clients every month. The data is there. And therefore, even though sometimes it looks like the SEC is making headway by proposing all of these new rules, there's also many instances where it looks like the SEC aren't actually doing anything at all. And I guess to answer the question as to whether the SEC are siding with Citadel or siding with us, I wanted to leave you with this response from Lisa, the former SEC branch chief. Robert asks, do you think the SEC is actually looking into all the manipulation with AMC? I mean, it's been over a year, the proof is there and it has been proven. Why is it taking the SEC so long? And Lisa says, I doubt the SEC is doing anything beyond issuing their report. Obviously, the SEC performed its investigation into AMC and GameStop and issued that GameStop report, but Lisa is thinking that the SEC aren't doing anything further. There is obviously some speculation that the Department of Justice has taken over from the SEC and is now performing a criminal investigation into the market manipulation and into AMC and GameStop, but obviously any proof of the pudding has yet to be seen. Now, something I also wanted to quickly touch on is Lou's bat signal emergency video. A few months ago, Lou said that he'll make a bat signal emergency video when the squeeze is very, very close and potentially only mere days away. Lou is obviously thinking that the AMC squeeze and the market crash is potentially closer than any of us ever imagined. Something Lou touched on during the video is Facebook's performance the other day and just how much money was lost amongst funds in that one singular day. Now, I too hadn't actually realised just how much money had been wiped off the planet until I actually ran the numbers. So Facebook or Meta Platforms is currently trading at around $230, $240 a share with a market cap of around $641 billion. A few days ago, Facebook or Meta Platforms was trading with a share price of around $323 and therefore a market cap of around $900 billion. And therefore, in the space of literally a day or two, Facebook lost around $250 billion. Now, on top of this, we also saw other large companies like Snapchat, Square and many others also lose a massive chunk. Lou totaled all this up to around $400 billion. Now, obviously, back in 2008, when Lehman Brothers collapsed, Lehman had a market cap of around $400 billion as well. And therefore, it took $400 billion to cause the 2008 collapse, and that's what we lost in a single day back on Wednesday. And therefore, I imagine that we are very, very close, potentially closer than ever, to the actual market crash. Obviously, since 2007, 2008, the market has expanded in size, and therefore I think it will take more than $400 billion to crash the market, but I don't think we're far away. So guys, be sure to let me know down in the comments below whether you think the SEC is siding with Citadel or siding with us, and also how close do you think the AMC squeeze really is? And as always guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.